Hello, everyone. Today on the final bar, we'll talk about the S&P, the other major indexes pushing onward and ever upward to the upside. Had some choppiness earlier in the day with some disagreement between the major averages, but sort of buying power taking over, overwhelming the potential selling pressure. The S&P closing above 4570. We're going to look at our market trend model, also the daily chart of the S&P, what key levels to pay attention to, also key moves in gold and cryptos. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the market environment using the language of technical analysis, using the technical toolkit to better quantify investor behavior, better understand the world around us as investors. Quite a choppy session, but really from lunchtime on Eastern time, it was really about buyers over sellers. It was about demand over supply or greed over fear, however you'd want to describe those dynamics. Certainly, the S&P major averages pushing to the upside. The Nasdaq had been higher through the course of the day, but really accelerated to the upside on some strength in consumer discretionary, strength in technology as well. Really sort of renewed strength to the upside. Tesla, the biggest gainer today. We're going to look at the chart of Tesla here in a little bit. On Mondays, we hit the market from three directions. We'll start big picture. We'll look at the S&P, maybe gold. Cryptocurrencies probably deserve a look after the move that they've had last week and especially over the weekend. We'll also look at sectors and individual stocks and themes, all the charts that I think you should be familiar with or should be following through the course of this week. We have great guests on the show. I was thinking about some of the conversations we had last week, just fantastic discussions about the market environment. Worth noting, two out of my three guests last week were talking all about Bitcoin with a pretty bullish outlook, which so far has played out pretty well. Tomorrow on the show, on the 29th, we have David Auerbach from the Daily REIT Beat. On Wednesday, the 30th, Mark Newton from Fundstrat Global Advisors. And on Thursday, the 31st, Tim Tashler, who's a strategist at Sprott Global, expert in materials, gold, and so forth. Let's continue on today's show with our market recap. Let's break down some of the recent market activity using the power of stock charts. The S&P 500 closing just around 45.75. It really accelerated to the upside through the course of the trading day. Earlier in the day, we had Nasdaq up, S&P flat, Dow lower, but all sort of resolving to the upside. Sort of the strength in the growth trade overwhelmed the negative move in some of the cyclical sectors, particularly energy, which is down about 2.5%. So the S&P up about 0.7%, the Nasdaq Composite 1.3% to the upside. Mid caps up just a little bit, and small caps actually lower. And there's more of a cyclical feel to the small cap index, which is why usually we'll struggle given the leadership and the laggardship that you see in the chart today. The VIX back below 20, which is interesting. Not too long ago, I feel like a couple of weeks ago, we're talking about the VIX up in the upper mid 30s and ramifications for that. It's starting to continue to fulfill that pattern where you look for an elevated VIX. The trick is just defining what elevated means, but looking for a high VIX and expecting a bounce higher in stocks. Certainly playing very well as stocks move higher. The VIX now back below 20. Quickly on some other asset classes, you had interest rates lower through the course of the day. It's one of the reasons why the growth stocks did so well. 10-year yield currently around 248. Dollar index up about 1/3% using the UUP ETF. Gold and silver both down today. So you had lower rates, weaker gold, precious metals. Silver down 2.3% with the SLV just below 23 now. And in general, pretty much all the commodities except for copper moving lower through the course of the day today. Cryptocurrencies really moved higher over the weekend, particularly going into the last 24 hours here. Bitcoin now right around 48,000, Ethereum at 3,400. So we've seen a downtrend in both of those. We've seen a consolidation phase. Now we've seen both of them resolve to the upside, I think, in a pretty firm fashion. Let's start to look at some of these charts on the macro indicators here, and we'll start with the chart of the S&P 500. And we review this chart most days on the show. And again, I was taught by one of my mentors, Rafat Kapoor, if you want to understand the market, be very familiar with the daily chart of the S&P 500. Tells you most of what you need to know about the conditions around you. And it served me well to stay focused on this chart and just always have a good sense of where things are at. So here's what's happened. We sold off through the first 2 months of 2021. We had an intraday low in late February. We had a closing low second week in March. From there, we've reverted back to the upside. Now, there have been a number of signals giving a sort of all clear of sorts, right? Or at least a rotation from a clean bearish phase to, at the very least, more of a consolidation phase, and at best, a flat out bull market phase or a constructive tactical market. Things that cross my mind as I'm looking at this chart: breaking above trendline resistance in terms of price, and using RSI, a momentum indicator, both indicating an influx of buying power, pretty significant. Regaining the 200-day moving average, getting above the March high, the most recent swing high, all of those pretty significant. I redraw the Fibonacci levels I was using only to take the high from January and the intraday low from February. And if you use those, you can see 38.2% was right there, around 43.80 or so. We broke above there, tested it in early March, broke above there a couple weeks ago. We've now, as of today, with the move higher, closed above that second Fibonacci level, that 61.8% level, which is right around 45.50. So getting above there, pretty consistent. We're now in the range of these highs here. And as I've said, if we get above the February highs, I can't equivocate as to whether or not this is an overall bullish configuration. I think you'd have to admit that it's overcome all of the obstacles in the way of being declared fully bullish. We have to get about those highs first, but every one of these points, I think, chips away at the bearish argument and shows that there's been a positive rotation here. And again, remember, the S&P is a market of stocks. It's an index of 500 different names with a lot of different charts and a lot of different themes, but it shows you that there's renewed strength enough to push the major indexes higher. Now, a big reason why you've had a lot of this move most recently is due to the strength in growth stocks, which we'll get to in a little bit, particularly when we get to the sector and individual stock portions of the show a little later today. Let's continue on our market recap, looking at some non equity asset classes. We'll start with the chart of gold because the GLD is all over the place, is a professional term we use to describe this sort of configuration. Gold was spiking to the upside. And as this was happening, we talked about how when something goes vertical, when something goes parabolic, it's a dangerous market only because a vertical move to the upside rarely just hits a plateau and then stabilizes. Usually have a big run higher, a ton of FOMO fueling this big run, and then things will come back very, very quickly. And the problem is you've gotten so far away from support levels, from moving averages, from any sort of trend following device that you can pull back quite a bit and still be within the definition of an uptrend. And I think that's how I've been describing the chart of gold so far, right? The resistance from November and really early February or mid February of this year, it's around 175 for the GLD. We gapped above there and then didn't look back and accelerated up to the low 190s here just a couple of weeks ago. From there, we very quickly came down. But notice that every time we've pulled back, even though it was a severe one and a sudden one, we've continued to make higher lows. Right, at some point that pattern changes. We don't make a higher low, and that could be a cause for concern. If I'm trying to label this chart of gold, I think it's a tough one right now. I can give a shot, and I think what I would probably do is talk about the pullback. The fact that we're making higher lows is impressive. The fact that we're remaining above the 50-day moving average is also impressive as well. This is on a bear flag alert for me, and what a bear flag is when you have a down move, a parallel counter trend move, higher highs, higher lows. You break down through that channel, which we've potentially done today, and that suggests further move back to the downside. Really, that would measure around to the 200-day moving average, which would be quite a sell-off in gold, given the run that you had up into to 193 plus. So I would look to see if you get validation tomorrow through the course of this week. But holding that March low is going to be key. That level's around 177. I think that's an important one for the GLD to hold. Silver, by the way, looking very, very similar to that. Just quickly, I wanted to touch on the chart of Bitcoin. We talked last week about Bitcoin. I think on Friday's show we did, and a number of my guests this week. What's interesting is I often even leave it very open ended for my guests. Give me 2 or 3 charts that you're thinking about, and let's go through them. And it's a great way to just see what ideas and what themes kind of bubble up. two of my three guests last week were talking about Bitcoin. Peter Brandt and I were talking about it on Tuesday, a really long-term chart of Bitcoin, monthly chart of Bitcoin showing this big, structural change and the likelihood of reverting back to the upper end of that range. And then on Thursday, Roman Bogomazov with the Wyckoff chart showing this rotation higher and breaking out of this consolidation. I think we've certainly saw over the weekend the signs that they were potentially picking up on. We talked about on Friday, really following through. And I think Bitcoin, Ether, some of the major cryptocurrencies really showing signs of strength with further upside potential there. Now is when you have to go back to some of those key Fibonacci levels. I think the 200-day moving average, which we're hitting right now, is a key one. The 50,000 level is a big round number that often serves as support or resistance. Beyond that, it's about 55,000 is a 38.2% level. I would be looking at those as potential support on the way up. We need to continue on today's show with our next segment, sector setup. So the big picture, we talked about renewed strength in stocks. And again, I think one by one, we're chipping away on the bearish argument that I think was very, very clear a couple of weeks ago as we're making new swing lows. All of a sudden, everything rotating back higher, strength and growth, also strengthen some defensive sectors. And let's look at that here next. So we're going to look at the RRG. I had a lot of fun, by the way, last week doing a webinar for the Money Show with Julius DeKemper. I've known Julius and I followed his work for years. So getting to be able to do a presentation with him is always a blast. We talked about sector and style themes for 2022, and some of the things we talked about is just this general movement with higher rates, this general trend of higher interest rates, and what that would tend to mean. Given that as the backdrop for 2022 and 2023, which I think most likely is how things probably play out, you're going to have periods where growth is working, and right now you're certainly seeing strength and growth in the short term. And you can see that on the weekly RRG, by the way, by these sectors in the lagging quadrant, but rotating to the north, right? So north means improving momentum or less negative momentum when it's down here. And the x-axis is sort of the strength, right? Further to the right is outperforming, further to the left is underperforming. The y-axis gives you more of the rate of change, more of the momentum underneath that relative strength. So further to the left, but rotating north means it's been underperforming on the longer term scale. However, the trend is starting to change. You're starting to show some signs of improvement in the short term that is causing that momentum in the underperformance to slow. So it's showing some potential strength there in technology and in consumer discretionary. We're certainly feeling that on a day like today. Energy on the other side, leading quadrant, but heading due south now. Consumer staples nearing the weakening quadrant. Utilities actually taking a right turn and heading south as well, along with financials. So a lot of these sectors that had been doing well and emerging in a period of relative strength starting to rotate down a little bit. Now, what can happen in a bullish market phase for some of these sectors is you actually get a clockwise motion to the right of the zero line. And that's what I'd be looking for in something like staples, certainly for something like energy, right? Is this something that's a long-term outperformer and you're just getting sort of, fits and starts or strength and weakness within that longer term context of outperformance? Same thing with something like technology and consumer discretionary. You see enough strength to propel it into the improving quadrant, start to head northeast. That's where it would start to really emerge as a longer term, stronger relative performer. At this point, still seems early days looking at the weekly charts at least. Now we can also look at the 11 S&P sectors using the candle glance function, which is what I like to do here. And if you have any chart list up, you can view list as candle glance. I always relate this to what we would do at Fidelity, printing out lots and lots of charts, putting them on a table and starting to put them in piles, the really good, the really bad, and in the middle. And then you'd take each of those piles and refine them a little further. And basically in electronic form is what you have here with the candle glance function. Let's put all these charts in one pile and let's think about some of these patterns. What looks similar, what looks different, any key breakouts or breakdowns, any outliers. What can you see about these? I'm struck when I'm looking at the candle glance function how many of these sectors had been going lower, right? Had been making lower lows in January, February, and now starting to rotate higher. Materials are a great example at a lower low in February and March, but breaking above their February low already. Real estate actually in the process of doing that right now. Lower low in January and February, all of a sudden making higher lows, breaking back above moving average resistance. The same with the utilities sector, which actually accelerated and has made new all-time highs. Consumer discretionary. Now, again, the XLY is very heavily geared toward three stocks: Tesla, Amazon, and Home Depot. When Tesla rips to the upside in the way that it does today, you're going to get a nice move in XLY unless the entire rest of the sector is lower or there's some huge disagreement between them. But you're seeing renewed strength, and the XLY is now back above its 200-day moving average. With any sort of move like this, as we've talked about many, many times, it's all about follow through. The last time the XLY got above its 200-day moving average was in February. If you look, we had a couple attempts to power through there. The biggest one was a gap above the 200-day, but the immediate next day we closed right below it. So you're going to have, when any sort of resistance level, but particularly with a moving average, you will get a close through the level. The question is, can it hold it, right? To get that follow through, what I call the confirmation or validation, some indication that this wasn't just a fluke, that you get further moved to the upside. That lack of follow through is what killed this rally in February. So I'd be very keen to see if we get or very interested to see if we get a repeat of what we saw there, which was this nice bounce, but before it sputters and you have a what's called an exhaustion gap, I guess, or I would say gap higher at the end of the move, or if we get that follow through. We did not get follow through in February. Do we get follow through this week and in next week for the XLY? See, the number of these other sectors as well have been putting in nice rotations higher. I mentioned utilities. I want to highlight healthcare as well. Healthcare, while the S&P is still trying to get above its February high, look at what the XLV has already done. February high was here on 133, we'll call it. We broke above that a couple weeks ago, pulled back and tested resistance from above. So resistance becomes support and now rotating back higher. That's just such a fantastic chart. And the pure technical way that you trade or the idea of trading a chart like this, by the way, is you take this breakout level, and that's what you call a pivot point or a level of polarity is what some people would call it, right? So a resistance level that you've now broken above and it's now support. That's an important level for this stock. The fact that it's been tested a number of times, the more and more this level gets tested, the more meaningful it is. You could argue this is actually coming from back here in November of last year. So this level has been tested a number of times. Holding that is key. As long as the XLV holds, it's a fairly constructive chart, I would argue, with a great likelihood of retesting the highs from December of last year. That fails, though, and the breakout is no longer valid. You have to look for further downside protection. Let's take a quick break. We'll be back with my next segment, Shifting Stocks. We'll see you in a minute. Hey everyone, welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thanks for joining us every weekday after the close as we break down these markets using the technical analysis toolkit, trying to better understand investor behavior and market dynamics. A couple quick comments before we get to my next segment. First off, we welcome your questions. Anything on technical analysis, on particular technical indicators, charts that you're struggling with, things you're hearing or reading in financial media, social media, whatever it is, we'll do our best to answer your questions. Our email is thefinalbar@stockcharts.com. We're on Twitter @finalbarsctv. We're on YouTube. Put a comment below the video you're watching on our Stock Charts YouTube channel. We'll gather all those questions and hope to answer one of yours live on the air on Tuesday's show of this week. Also, go to stockchartstv.com. That is our on-demand platform. It is completely free. Special market commentaries by people like Larry Williams, Martin Pring, many, many others. Special events like our Women's History Month specials that we aired over the last couple of weeks. Chart Madness, which we recorded last week, a bracketology themed stock picking exercise. So much great content just to nudge your thinking and help you improve your understanding of the markets. Go to stockchartstv.com or on your mobile device, just search for Stock Charts TV on demand. Let's move on to our next segment, Shifting Stocks. This completes our three-pronged approach to every Monday. Big picture first, sectors second, and now talking about individual stocks. We'll hit on some of the key names that are on the move. I want to start with Johnson & Johnson, which is not a super exciting chart, not a super exciting stock, I mean to say. However, the chart's starting to actually work. I'm highlighting J&J as a stock making a new 52-week high today, just to remind you that one of the things we've talked about a number of times on the show is that a bullish market phase is usually noted by an increase or a healthy number of new highs. I was talking about an expansion in new highs. For the S&P to be able to make new highs, you need a lot of individual stocks making new highs before the fact. The index is never going to be the first thing to break out. It has to be other stocks that are leading the market higher, that are propelling the indexes to the upside. Stocks like J&J doing so certainly help. This is a mega cap name, obviously a fairly a large member of the healthcare sector, and making new 52-week high is not a small thing. Again, charts like this making new highs, I think, are usually a bullish sign. New highs are bullish, is one of the ways I always describe it. The question is, do you get the follow through? Do you validate that? Do you hold that breakout level? The momentum is strong, and overall, it's an encouraging chart. It's interesting to remember though with charts like J&J, you have to think about the volatility. So remember, this entire range is from around 115 to 177, about a 60-point range there on a $175 stock. What you have to remember is with a lot of times on charting platforms like StockCharts, pretty much all of them, we always expand the price range to fit the vertical data. I was debating with Greg Schnell about this recently about different ways to think about that. Because you have to remember, if you look at two charts, the vertical space may look the same, but the charts could actually be a very different level of volatility. An example of that would be something like GameStop, which is going from $3 on the left to $500. It's showing the same vertical area, even though these are huge percent moves, a 25% move just today. So something like Johnson and Johnson may be encouraging. Focus on the relative strength and how far it's able to outperform a major index. A lot of times that can help you compare things on an apples to apples basis. That was a horrible transition into Apple, as I said, apples to apples, but it's the next chart on my list. What's interesting about the chart of Apple is if you take a trend line using the previous highs, it starts to be pretty encouraging. This is what's happening with a lot of the growth charts that I'm following. The growth to value ratio now pivoting back, favoring growth in the last couple weeks, and charts like this certainly showing some strength. Here's a trend line from January and February. We're now breaking it back above that to the upside. The S&P doing that is important as well. Here's a horizontal line right at the February highs here. You can see we're right there. So 175 is a key level. That was the February high there. The question is, can Apple get above there and power through it? If so, I think we're on the way to much further highs for Apple, and I think the market could certainly propel much, much further. The danger to that thesis is if you're going to own everything, if things start to get squirrely and you still want to own some technology, you'll probably park it in a fairly defensive thing like Apple and Microsoft. So there could be a scenario where the market rolls over and Apple and Microsoft actually hold up there pretty well. However, a big, mega cap name getting above resistance and powering through, I think would be a fairly bullish sign for the market. The RSI, by the way, above 60 did not do that in February. It is doing that here in March. I have to count that as bullish evidence for sure. Nvidia is another one. We talked about some of these names last week. Again, breaking above trendline resistance, all that's encouraging. This one did get above its February high, and again, holding above there is encouraging. The RSI is getting above 60. So within technology, this is starting to feel more and more like a constructive move. Bear market rallies usually fizzle out at previous highs. They fail to regain resistance levels. They fail to follow through. I think you're at that point where you have to start recognizing that some of that follow through is certainly happening to the upside. So if those charts are working, what kind of charts are not working? Well, energy, it's hard to say that this isn't working because it is. And if you look over the long term, chart in the XLE is actually pretty constructive. And we could look at a lot of individual names, but the chart of the XLE is actually a pretty good proxy for most energy stocks. It's a fairly homogeneous sector where most things are relative to oil prices. What's interesting right now, and I think one of the reasons why the growth to value ratio has been favoring growth in the short term and certainly could continue to do so, is because you have some signs of overextension on these energy stocks. Right, you had a big rally in early March. We pulled back, but again, that was only again, pretty significant move, but not that much from a technical perspective. Right, still a consistent pattern of higher highs and higher lows. Right now, you're getting a bearish momentum divergence on the XLE on a closing basis, higher high on Friday from where we were in early March. That's met with lower momentum. So overbought on the first new high, not overbought on the second one. So that's higher prices, lower momentum. It's actually a bearish momentum divergence. Now, the chart of the XLE, I would argue, still remains fairly constructive, even if you pull all the way down to 70. That's about an 8 to 10% drop from current levels. Again, not that necessarily that's going to happen. I don't know. But what I would tell you is you could have that much of a drawdown, still remain above the March low, still test the 50-day moving average. And this is a nice, consistent, orderly uptrend with a decent pullback in the middle. That could give space for some of those growth stocks to continue to work on a relative basis for sure, and then potentially set the stage for the next move higher in commodities and in energy stocks. So while you're seeing renewed strength in some of the technology stocks and not yet overbought, you're getting a bearish momentum divergence from the energy space. I mentioned Bitcoin, and I'm often asked about GBTC. And again, this is not an ETF, it's a trust. So I would definitely do your due diligence on something like this. ETPs, exchange traded products, are things kind of like an ETF, but different. And the challenge is the further you get from an ETF, the more different and what's the word? Non-traditional or surprising the structures might be. And again, GBTC, I don't necessarily have a problem with it. I would just make sure you understand the structure and understand the risks you're taking on before you would go into a name like this. It's not an exchange listed ETF, something like the SPYs or the Qs. However, had a nice bounce. And if you look at the support from May, June, July, we retested those same levels. Now we're rotating higher just today on a closing basis, reaching above the highs from January, February, even early March, which were right around 32. So getting above 32 is impressive. It was up about 9% today. Holding that breakout level would be super encouraging. Not far from the 200-day moving average. That's the next level I looked at. We failed there in late December. Love to see if the GBTC can regain that. But overall, given the strength in Bitcoin, the fact that the RSI is getting above 60, certainly rotating to more of a bullish phase with some upside potential. Just want to leave it with a couple things. I had so much fun with Greg Schnell a couple weeks ago doing a webcast on cannabis stocks and just talking about downtrends. And our main thesis was these are charts overall in downtrends, making lower lows and lower highs. Look for that pattern to change. On Friday, MJ, which is one of the more liquid ETFs tracking cannabis stocks, we did it. We got above 11 on a closing basis, taking us above the February highs. No follow through today. So these names are pulling back a little bit. Tilray is probably one of the more commonly known names, TLRY, one of the largest market cap names in the cannabis space, getting above 750. I'd love to see if those stocks could hold that, but overbought on the jump higher. Right now, can can Tilray hold 750 would be the question. Can MJ hold that breakout level? Really, really close. And again, I think the long-term thesis on these could be pretty encouraging. But first things first, we have to start making higher highs and higher lows. Great charts to watch this week. We need to wrap today's show, folks. Go to the 3 and 3, three charts in 3 minutes. Here we go. Chart number one is actually looking at the daily S&P chart. We talked about this earlier in the show. I love to pay attention to this in my morning coffee routine. I look at my market trend model first, and I look at this chart second. I've done that same thing for years, and it's helped me to have a good sense of what's happening with equities. When I take a step back over the weekend, when I look at the chart with fresh eyes this morning, it's hard to disagree with the renewed strength in stocks. I called this a bear market rally. I'm getting less and less comfortable labeling it as such because of all the things that I listed out. I did a webcast for the students at Texas A&M last week, and we talked about, or maybe it was the week before that, talked about, the overall sense of trend following, which is number one, identify trends. Number two, follow those trends. Number three, anticipate when those trends are reversed. But most importantly, follow the evidence. I'm seeing mounting evidence that this is an uptrend with some significant strength behind it. And you're seeing that as we regain levels. You're seeing it as we break above key points and not yet overbought on the S&P 500. But the RSI breaking above 60. This is starting to show some real strength. Get above 4,600. I don't think you can really label this as a bear market rally anymore. Chart number two is Tesla, obviously a big mega cap name within consumer discretionary, up 8% today, a little bit more earlier in the session, but powering well above 1,000. Big round numbers are always important to watch. 1,000 came into play last week. Tesla stalled just a little bit, and now we're gapping higher to push onward to the upside. Overbought on today's close, given the move higher, but the fact that we've now rotated above that last Fibonacci resistance level, I would argue clears the way to all-time highs. I think we could be going to the 1200s here. By the way, this is a great masterclass on Fibonacci. May low of last year, November high of last year. Look how every one of those levels was touched and confirmed. Finally, the XLE, bearish momentum divergence. Watch this chart. Stocks going higher on weaker momentum can always be an area of potential concern. Folks, that's a wrap for this show. Thanks so much for joining us every weekday after the close. All of our previous episodes at stockchartstv.com. For stockcharts.com in Redmond, Washington, I'm Dave Keller. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.